Joining us now is Raymond James analyst David Long. And David, given the numbers we've seen, let me ask you what Leslie just raised. I mean, is it an all clear sign for investors when it comes to regionals?
Look, I believe the all clear from a failure perspective, we're getting close to that. When you looked at the banks that failed, you were able to analyze them 6 to 9 months ago and say that they had holes in their assets that were underwater that would eliminate their capital if you had to mark all of their assets to assets. We've been through our coverage of more than 130 banks within the Raymond James franchise and several of the other larger banks, and we don't get to that conclusion with any of the other banks. If you mark all of their assets to market, they still have capital, still have tangible book. So I think we're clear there, but I'm not going to bet the house on it.
And what about the larger issue or the larger concern, namely the earnings power of many of these banks, given facing higher deposit costs, still the risk of deposit flight? What have we learned from what we've seen from these quarterly numbers in terms of answering that question?
Sure. Well, deposit competition was very intense in the second quarter, and particularly in June when a lot of banks were looking at or facing quarter end and said, we'd love to show an increase in deposits for the quarter. So that really accelerated the competition in June. I am hearing competition in July has come off a bit, but deposit competition is causing that cost of funds to rise pretty substantially. As you just stated earlier in the segment, these deposits are moving either into higher cost deposits or even off of bank balance sheets into Treasury securities. From a bank perspective, the two biggest headwinds are the rise in costs, moving the funds into CDs, and that are cost much more than your money markets and non-interest bearing. But something we've been talking about for at least 9 months is non-interest bearing deposits. Non-interest bearing deposits, when rates are zero, got up to be 25-30% of deposit mixes. Pre-Great Financial Crisis, that number was in the mid to high teens. I think a lot of banks have, with their guidance, not had a moment where they can say we're going to go back to that level. Most management teams have focused on going back to pre-pandemic, where we were in the mid 20% range in non-interest bearing deposits. As we look forward, we think we're going to go to pre-pandemic levels, and some of the bank pre-GFC levels. And I think bank management teams are finally starting to come to that realization that non-interest bearing deposits are declining, and we could go back to pre-GFC levels. Look, that was the last time that rates were this high. So depositors are demanding more for their cash.
But haven't we heard, I heard this from Walt at Schwab on the show, that is tapering off, that there's been a sort of stabilization in that trend and it's starting to go the other way?
Absolutely. I've heard the same thing. There has been some stabilization there. But most of the banks I'm talking to are still seeing flows even in July out of non-interest bearing into interest bearing. So that's going to be a bit of a headwind here for the near future. I think this quarter is a big degradation to bank net interest margins. It could be the steepest that we see this cycle, but I'm anxious to see how competition fares out intra-quarter. If you look at the second quarter, the regionals, the small banks were all competing for deposits. Names like Wells Fargo, Bank of America, JP Morgan, we did not hear about them competing for deposits. If they come into the marketplace more aggressively on deposit rates, we're likely to see a pickup in that competition.